Okay, so it looks like the first question that came in is related to the Power Options portfolio. David says, how do I adjust the portfolio for a stock that I have 200 shares in and they reduced it to 40 in a split? Okay, well the key about a split, David, is that whatever monetary value you had on the position before, you have on the position now, or the moment I should say, right after the split. So for example, if I had bought 200 shares of, let's say, a $10 or $20 stock, let me just go to a new portfolio here. We'll just call it split, of course. I'm sorry. Okay, let's just put in, let's just call it 20,000 for now. Okay, so I'll just create a new portfolio. We'll put that in for 7 days ago. Okay, now let's go into the portfolios and we're going to add in 200 shares of a stock. Let's say it was trading at $20. So I'll just go long stock and I'm going to put in ALLY. It's a little bit above $20, but for our example, we'll use that. And I'm going to buy 200 shares. Bought it last week. This is not the stock that split, of course. And our price per share was $20. Okay, so what do we know? Well, we have a total of $4,000 invested in this trade. Now, after the split, my 200 shares went down to 40, of course, right? But that same monetary value is in play. So even though the stock's at 21.11 right now, we're just going to treat it as 20. But when the split happened, I know what my monetary value was in the position. Okay, so I had $4,000 in. Now I only own 40 shares of stock because of the split. Okay, but those 40 shares have to equal $4,000. So my price to share would go up to 100. So what I'll do here is I'll use the More Information button. We'll go to Position Actions. I'm going to go to Edit Position. And I'm just going to change this now to a quantity of 40 with an investment amount of $100 per share. Okay, so now I still have the same $4,000 value. The value of the position, of course, is a little bit lower. It's 21.21, but that price would have changed naturally. Like I said, this isn't the stock that split. In this case, the price would be up at around 112 or so. So the monetary value going in has to be the same as the monetary value going out. So if you have a 2-to-1 split, a 5-to-1 split, or a reverse split, what you want to do is go into Position Actions and just edit the position and change the number of shares to your new number of shares that you own, and change the cost basis based on the split as well, and then you'll start tracking that as the new position. Monetary gain or loss would be the same. This one, of course, looks like a disaster because the stock didn't have a 5-to-1 split, so it's not priced at the 105 or 110 range it would have been had this been the stock that did the 2-to-1 split. Of course, if you're entering a position in the portfolio and you made a mistake, let's say that I put in 400 shares instead of 40, or 4,000 shares instead of 400, or if I put in a cost basis of 10,000 because I forgot the decimal point instead of 100, you'd follow that same feature. Just use the Position Actions and then Edit Position, and then that would get you to a point where you could change the number, of course, make any changes you need. A common mistake I see entered from time to time is, let's correct this. Let's just go back to our 100 shares at $20 real quick. Okay, for the real price. And then, of course, an investor would want to track their commissions. So they want to put in a commission of $5.95 or $4.95. Okay, so they put in their commission, they hit Submit, and they say, wait a minute here, I bought a stock at 20, it's up $1.15, how am I losing $1,000 on the position? I should be up $115. Okay, well, you saw what I kind of did there. If I go back into Edit Position, I see that I put in a commission cost of $595 and not $5.95. So of course, we'll just make that change. That does happen from time to time. I've done it myself in my account once or twice as well. After rolling a call, I put in a commission of $870 instead of $8.70. Okay. So David, that's how you want to do it. Just adjust it based on what your new cost basis is for the position on those new number of shares. The money that you had in the position pre-split will equal the money you had in the position post-split. So just make those changes based on your cost basis and how the split affected that as well. Okay. Okay, that's the same process I use, by the way, if I add shares. Let's say I was in a covered call right here where I had sold the 20 strike call, but I decided to add another 100 shares that I bought at 2010 and sold an additional call. What I would do in this case is go to position actions again from the portfolio and edit position. And of course, since I bought another 100 shares at $20.10, I know now that my average cost basis is $20.05 for 200 shares. So I just change the quantity to 200, change the price to the average of the cost basis of my two legs of the position. Now I have one 200 share block of stock in the portfolio that I could sell a call against in this case to track it as a covered call, really two calls against it to track it as a covered call position. Okay, so that's how we'd edit the position. Another question that comes up from time to time I want to point out while I'm here, for those of you maybe just getting started with the portfolio, when we saw that I went into the setup and I put in a name in a portfolio, a cash on hand, and a starting basis as the same. Okay, I start off with $20,000. My starting basis and the cash on hand were equal. Just if I funded an account today for $20,000 and it cleared, well, I have $20,000 to trade with, and my return is going to be based off the starting basis of $20,000. Now let's say we're 10 days later and I wanted to add another $5,000 to the portfolio. Okay. Well, in here, the portfolio details, I can click on starting basis, for example, and that'll take me back to the main field. And now what I want to do, of course, is change the cost basis or the starting basis and the cash on hand. See, what a lot of new investors will do on the portfolio is they'll say, okay, well, here's my portfolio. I've got this one position. I've got $15,984 of free capital. I'm going to add $5,000. So my cash on hand is going to go up to $20,984 and 56 cents, whatever. So we'll just call it $20,984 because I just added $5,000 to the cash. Now, however, when I go back to the portfolio after saving that change, my portfolio is showing a return of 26%. Well, that's because it's basing it off of the starting basis. So if I just add cash to the cash on hand, I inflate the portfolio return. So what I want to do is when I'm adding money into a portfolio, funding an IRA, and I'm tracking that in PowerOptions, I want to make sure that I add the new funds to the cash on hand as well as the starting basis. Okay, so now when we go back, it reflects evenly, and here we are again back at that 1% gain for the one position that we have in place. So it's more accurate, it's not inflated, or it's not deflated for doing it in the wrong direction. Okay. Okay. This is an interesting question. I don't have a, off the top of my head, fantastic answer for, but of course I'll give it a go. Paul wants to know, Mike, if we're trading credit spreads and iron condors only in a portfolio, so a whole portfolio devoted to iron condors and bull put credit spreads, a bear call credit spreads, it says what % of the account should be left free for adjustments? I'm going to say, in general, I would leave close to maybe 20%. Now, as a general rule, personally, and this, I'm not telling you how to trade, of course, you all realize that, but myself personally, I only trade credit spreads with about 15% of my capital due to the 10-to-1 risk-reward ratio on high probability spreads. Okay. But let's say, for sake of example, what we're doing is we're trading most of our, if not all of our portfolio into leverage credit spread positions. How much should I leave on hold for management? Off the top of my head, I want to say 20%. And the reason why is, let's just take a position, a portfolio of, say, $20,000. And we'll say $25,000, okay? So let me delete our Ally stock position, clear that off the board. Okay, and of course I still lost about $5 due to commission, so that's why it's not even at this point, but that's perfectly fine. And I'm going to try to do this real quick. We're just going to go to bull put credit spreads on the search, and I'm just going to open the first 5 or 6 positions. I'm going to allocate about $5,000 to each one. Okay, well, I'm going to do $4,000 to each one. Okay, that was interesting. Let's go to initial values. Here we go. Okay, good. Acacia is a 5-point spread. And so we'd probably do 8 contracts of the Acacia position for $4,000. So not even researching and analyzing, let's just add it to the portfolio. Split testing, my apologies. So just bear with me for a couple moments while I add these positions in. We're going to use no commissions to keep the math simple. Did I do 88? I did. See, now I got to edit the position. So we'll go to Position Actions, Edit Position. Let's get that correct. I only sold 8 and 8 on the 5-point spread, so we're going to have roughly take in $1,200, of course, but the monetary requirement is going to be the net credit of, wow, $720. I'm sorry, it's 90 cents. So we've got about $4,100 off of this position. Okay, we took that went up, yeah, but okay, there it is, the 4,000 or so, 3,000. Okay, let's go back to bull put once more, and that's another 5-point spread. So we'll do 8 contracts of this one as well. I'm going to be as quick as I can here without going too fast. So we're just, putting in about 3,200 into each position, really. Okay. All right, on 5-point spreads here. Back again. Next one's NVIDIA. Good, it's another 5-point. I could be doing 10 contracts, but I'll show you why I'm using 8 in just a moment. Okay. Here we go. Just 2 more, I promise. Okay, so we see where we're kind of going with this. The reason why I'm suggesting 20% is because if I opened 5 positions, remember I had $25,000. If I opened 5 positions with a 5-point spread, and I'm doing about 8 contracts a piece, really about 4 positions in this case, but we'll do 5, okay, because we're doing 3,200 roughly in each one. Okay, so my cash on hand right now is increasing to $2,786. My margin requirement is $13,000, so I'm dropping my buying power down to $14,000 or so. Okay, I got to add I'm sorry, I'm going in the wrong place. My apologies, folks. Regeneron, good. This is a 10-point spread, so I'll do 4 contracts. And this is okay. So I guess I'm going to do one or 2 more. I'm just going to do 1 more. So we've got 5 bull put spreads. Let me open now that yours could of course be different. You could have iron condors, a mix of those. I'm looking at a 5-point spread here. All right, just 1 second. And of course you may do less contracts for more trades and so forth. All right, so I've got 6 trades open, 6 bull put credit spreads. My buying power has been lowered down below $10,000, okay? This is more than 20%. Why? Well, think about it this way. What is the biggest risk I have? It's on that 10-point spread, isn't it? In fact, I probably should have left more money available. But look, here's the 10-point spread. I'm sorry, the 350 to 360 on REGN. And we did 4 contracts, okay? So the maximum risk is about 3,360. Now, we didn't check it in the search, but most of these positions that we opened were probably a 75 to 80% probability. We want better than that. We're searching for 80% probability, but we know, and we've seen before in other webinars, and we can show it real quick, that even if you're expecting an 80% probability, which means you're looking at possibly an 11% return or about a 9-to-1 risk-reward ratio, you actually need to be right closer to 85 or 90% of the time long-term to make a profit. But I have to assume that even if I'm opening positions with an 80% probability, there's a chance that 1 or 2 of the 5 or 6 I have opened, 1 or 2 of the 6 that I have opened, 80% or so, maybe a little bit less in worst case scenario, might go against me. What happens if a bull put spread goes against me? I have to be able to cover the monetary loss on the position. Okay? So in this case, I'll close down some of these here. Let's go back to the 10-point spread. And we received a net credit of 640, so we've taken our risk down to 3,000 360. So if some bad news comes out and REGN gaps down from 380 to 345 before I can do anything in the pre or after market hours, I'm going to have to close that spread. And it's going to cost me $3,360. Okay? So where I'm going with this is that you know more about your portfolio, Paul, than I do. You know more about what your typical monetary at risk is based on what spread width you use, how many trades you're making, of course, and how many contracts of each. Another way of me phrasing this is, instead of like a 20% hard rule, if you break down your portfolio a little bit more, if you're looking at basically a 70% probability when you open your spreads, I would say that you want the full monetary requirement, assuming the full loss, on 3 out of 10 of those positions, 30%. Okay? Because you know from time to time things are going to go against you. As a bare minimum, right? I would not saying 30% of your portfolio, but 30% of those may go against you if you're just looking for a probability above 70%. You have 10 positions open, you might assume that 3 of them might go against you. And if they go against you for the full loss, you need that monetary amount to close the positions. You're looking for an 80% probability. I would look for having the monetary capital still on hold in your account, not into the trades, where it would cost you to close 2 of those spreads for the full loss, or 20% of the spreads you have open. If you have 20 spreads open, naturally you'd be looking at the total cost of 4 spreads, because they're going to go against you. I don't want to say inevitable, that's in the wrong term, but the unexpected will happen. The market dictates the prices, not necessarily our stock picking and reliance on stock charts and trends and things of that nature. So positions over time will go against you, and some will go against you for the full loss, and you'll have to have that monetary amount available to close them. So this would allow me to close out 2 of my 6 spreads, roughly 30% or so, if they went against me. It does become tricky if more than that goes against me, because now I've got to find the capital to close out those positions and those obligations. But in general, I should be able to get a reasonable price for them. Okay? So, you know, long-term, Paul, think about it. Think about your track record personally. I mean, you don't have to tell me what it is, but think about your track record over the last few months, the last 6 months, maybe the last year even, in spreads and iron condors. And how often, I should say, did positions go against you for a loss, and how often did some of them go against you for the full loss? That'll kind of give you a gauge of how much money you should have on hold, assuming that your track record stays at about the same, so you don't get caught where you have to close a position and you don't have the funds available. If 3 of these went against me now, sure, I've put the money on hold. It's already there. I agree. You know, what do I mean by that? I opened this 10-point spread, and I collected a premium against it. Okay? So I had to put up the money there. That's taken account for, but I have this extra capital for other management if I want to roll it, if I want to adjust it, okay? Rather than just closing it out and freeing up this, sometimes I might want to actually increase the strike difference. You know, if this, I've done that before. Let's go back to the profit and loss chart here. If REGN drops down completely against me or moves against me, let's say it goes between our strike prices, okay? And I need to manage this. Well, it's not going to be simple for me. Let's say the stock goes down to 355. It's not going to be very easy for me to simply just say, okay, let me close the 360 and close the 350, and I'll roll it down from April to May at a 345, 335 spread, and that'll make up for the $4 loss I took on the position. No, it won't. You made $1.60 on this spread, and then let's say you took a $4 loss, so you're losing $2.20. Well, this next spread is probably only going to give you $1.10 to $1.50. It's not going to give you the $2.20. You could get $2.20 if you maybe sold the 355, and then instead of buying the 335, buying the 325, or maybe buying the 330, creating a 20 or a 15-point spread. So you keep more of the 345 premium to hedge the loss you just took on this position by going wider strikes. But that means you got to put up more capital, and that's where some of this extra might come from as well. Okay, so the money, you're right, the comment was made and I wasn't denying that. The money is on hold for this 10-point spread. That's why it came off of my buying power. I've already got that accounted for. But other adjustments and the cost for rolling, I may still want to leave that aside in case I get trapped. Another case that can happen, which hurts, and hopefully your broker won't do it, and I'm not saying you should have the capital available for all these situations because you just couldn't. Why would you be betraying it? What I'm saying is, if this stock dropped down to 355 for an unexpected event, REGN, okay, if it dropped down to 355 over the weekend, or pre-market on Monday, excuse me, before I could do anything, and I all of a sudden find out that I was assigned early, and I had to buy 400 shares at 360. Well, I'm not going to exercise my put to do that because the market's offering 355. Why would I try to get someone to sell my stock or buy my stock for me at 350? I'd sell it at 355. But you know, of course, that early assignment might happen in that situation where it's between the strike prices. You don't get the value back from the long option. You don't have a loss, but you've got to have the margin rights and approval so that the broker can borrow and put you on leverage to get those 400 shares at $360 a margin. Doesn't always happen, doesn't happen often, but remember, anytime you're doing a bull put credit spread, that is a potential outcome. If it's between the strikes, you may end up being forced to buy, or you might be early assigned on your short put strike. And the long put is not doing you any good right now. Why would you want to sell, if you were put the stock at 360, why would you want to force someone to buy it from you at 350 if you could sell it at market at 355? Okay. So yeah, I'm leaning towards the 20% kind of rule. But again, you can also gauge that based on your contract size, your spread width, and how many positions you open up in your portfolio as well. Another topic of conversation, I had mentioned that one might consider, you know, if you're doing 20 spreads or 30 spreads. I had a conversation with a customer yesterday, doing similar what you're doing, Paul, and they're doing between 40 to 45 spreads every 2 weeks. They kind of roll individually, so 20 of them are open for 7 days out, 20 of them are open for 14, and it kind of goes back and forth rolling the positions. To tell you the truth, I don't have the patience or time to manage that many positions in a portfolio. Okay, especially spread positions, especially weekly spreads where you have to watch them almost on a daily or hourly basis because you probably only received a credit of 10 or 15 or 20 cents up front, maybe on a 2-point spread or maybe on a 1-point spread, but still, you're fighting nickels and dimes. And if you're trading 40 positions, you've got to watch all of them more frequently to make sure that you don't lose track of 1 or 2 of them, which would wipe out 15 or 10 or 12 previous wins, or 15, 12, or 10 positions that are winning right now. Okay, that's sort of the risk with the spreads that offer the high probability, 80% or more, even 70% or more, but come with sort of a 10 to 1 or 8 to 1 risk-reward ratio. Okay, so 20% is a good hard rule, 20% of your portfolio for adjustments. Of course, you know, I agree with the comment and the statement that was made that when you open the spread, hey, the money you would need to close the position is already put on hold, so why would I need more capital? And it's because of what adjustments you might want to make if you are forced to buy the stock early, or of course, you know, if you're in a bear call, you might be forced to short the stock early. You know, what do I mean by that? If I'm in a bear call spread where I've sold, let's say, a 350 call and I've bought a 340, or let's just take one on S&P here, for example. Just look at the profit and loss chart of this bear call spread. So we're selling the 239.50 strike call and buying the 241 for insurance in case the stock gaps up. Well, again, if it goes to 240 and I'm assigned early, well, this call obligates me to deliver shares of stock that I don't own. So essentially what's going to happen is I'm going to be short shares of stock at the $239.50 cost basis with a 241 call to protect it. It's a married call, essentially, which is still a bearish position. So if the stock continues to go up, I can still have more losses on the position. So in the bull put side, I could be forced to buy shares of stock if it ends up between the strike prices and assigned early. And on the bear call, I could end up short stock if it goes between the strike prices and I'm assigned early on my in-the-money call, where the long call is not really helping me yet as far as capping the loss. It is if it goes further, but right now I'm in sort of a new position. I'm in kind of a married call that I could still lose more if the stock continues to move up, but I can't lose more than that initial full loss on the position. But again, here we see we're making 21 cents for risking $1.29. So here we're at about a 6-to-1 risk-reward ratio. So if I take one loss, this might wipe out 6 previous gains if this is the structure I'm using for most of my positions, meaning that I'm looking for a 12 to 15 to 16% return with X amount of probability. So all of my positions not going to have the same net credit to monetary risk exact numbers, but I'm probably looking at a 6-to-1, 8-to-1 risk-reward ratio across my portfolio. So one loss would wipe out 6 previous gains or 8 previous gains as well. Okay, a quick question came in and said you were talking about if I have an 80% probability, I need to be right 90% of the time. That doesn't make any sense. Why would I trade with an 80% probability? I only need to be right 80% of the time. Well, unfortunately, that's not how the math works. Let's go into bull put credit, and let's go into search again. Okay, and I'm going to set up as Jim. I'm sorry, Jim. I'm going to set up a search looking 1 week out with what we're talking about with an 80% money. Okay. All right. Okay. Okay, and oh, John, I'm answering Jim's question now, and John, I'll get to your question right in a way I think it's going to appeal to everybody and then not appeal to everybody. We'll talk about that in just a moment. But first things first, let's create a search. 1 week out in time, bull put credit spreads. We'll just go 1 to 8 days out in time. I'm going to look for a minimum net credit of 10 cents to make it worth our while. Our probability, we're going to isolate it. Okay, I'm going to go 78 to 84%. So they're all around the 80 percentile. Okay, and I'm not even going to be concerned with a lot of other stock criteria and other things of that nature. We're just going to look at moneyness. 10 cent net credit, percent return. I want it to be at least 11%. So we'll go to 10. Okay, and open interest, I'm not going to worry about delta, range out of the money. Well, of course, I want it to be at least 0% of the money, but the probability is already taking care of that. Strike difference. Let's keep the math simple. Let's set them all to 5. Okay, standard 5-point spread. Okay, there's only 7 trades. I was hoping for 10, but there's only 7 trades. All right, so Jim, here we go. All of these positions are around an 80% probability, a little bit above some 78s, a 79, 83s, 82s. So let's say on average we're at an 80% probability. And now if we had 10 trades, of course, we'd know that if 2 of these went against us for our full loss, well, then of course we'd lose on 2 positions and be right on 8 of them. But would that be at break even? Let's take a quick look. All these are 5-point spreads. Credit is varied between them, but we're talking about a gain of about 16%, okay, on average. So it's 27, 21, 19, 16, 13, 12, and 12. So maybe 17% leveraged return. Well, what does that equate to? Well, let's just take a look at that one. NTES 285 by 280, 5-point spread. Net credit of 70 cents. So let's call a 75-cent net credit, okay? A 75-cent net credit on this position, let's increase this to 180. Okay, will be about a 17% return that we're talking about, 17.6. Okay, so we're a little bit higher. But what is this risk-to-reward ratio? Look at it. We're making 75 cents. Let's say all 10 of our positions took in 75 cents, and the monetary risk is 425. Okay, so I enter 10 positions. Each one contract apiece. It doesn't matter if you use 5 contracts, 10 contracts, or 20. But I open 10 positions, all of 5-point spreads, all with a 75-cent net credit. So what does that mean? Well, I take in $75 for each one, so my monetary value in is $750. I'm risking $425 on all 10 spreads. Okay, so it's about $4,250, and that 750 over 4,250 would still be 17.6, 17.5%. Okay, but we've got 10 positions all at 75 cents with a risk, 75 cents, with a risk of 425. We take in $750 capital up front. What at expiration? 9 trades expire worthless, 1 goes against us. We're right 90% of the time. We have to pay $425 to close that position. Okay, so what does that mean? It means at the end of the month, we take in $325 worth of profit. $750 was generated right away. We had to pay $425 back to close one of the losing positions. And so we make $325, and we still had the investment of $4,250 for all 10 spreads. It's still a positive return, 90% success rate. Now, what happens if 8 of the trades expire worthless? One of them falls a little bit below the short put strike price. So we only lose 210 instead of 425. And then the 10th position goes again for the full loss. Well, now we have to pay back the 425 plus half of that of 210. Okay, so now we're down 675, so we make a profit of only $75, which would take us down to 1.7% gain. But this is one position that went against us for the full loss, one that went against us for only half the loss. We might call that an 85% success rate, because 1.5 of the 10 positions went against us. Okay, so 85%, we're still doing okay. We're making a small profit, but it's not great. It's not the 17% we want. It's about 1.7%. And we're essentially right on 8.5 of our 10 trades. 2 trades go against us for the full loss. You can see it. What would that mean? Now I have to pay back $850 to close the spreads. 425 times 2. So we pay $850. We only took in $750 of credit, so we're down $100. And we were right 80% of the time. So on these spreads that offer this 8-to-1, 10-to-1, 7-to-1 risk-reward ratio, when you're looking at probabilities of 80% or more, you have to be right more than 80% of the time. Or, now this is just the basic view. Okay, and this is what a lot of investors, sometimes find themselves getting into trouble with on these credit spread portfolios. As they find positions, say, yeah, I'm going to be right 8 out of 10 times. They find they were right 8 out of 10 times, but they came out of the month a loser. The 2 factors that really come into play here, and of course, Jim, you'd mentioned it, and I agree with you, but this is what I was saying, that the math doesn't work. If you open a position of 80% probability spreads that had this 8-to-1 risk-reward ratio roughly, it's a little bit, yes, about that, 8-to-1, maybe 9-to-1 risk-reward ratio, really, you have to be right 85% of the time or more to be successful. And that's an extreme example, Jim. I agree with you, because I'm talking about maximum loss. And you said, well, you could manage the positions. Of course you can. But again, sometimes the unexpected happens and will happen. And you will take a full loss on the position before you can do anything. A stock suddenly gaps down against you. Let's say that you were in Mobileye. Just got the offer from Intel. The stock went from about 50 up to about 62. I think the buyout price was $63 or $62. So overnight, before the market even opened, it just ramped up before anyone could do anything. And that happens rarely, but it does happen. But let's say a week before that, you were looking at Mobileye, and maybe you're looking at the whole market and saying, yeah, it's still going up, but I've seen some hesitation. I really think the market's overbought. And you did a bear call credit spread on Mobileye. Guess what happened in the morning when it gapped up to 62? With the stock trading at 50, you might have sold at 55 and bought a 60. And the stock suddenly gapped up to 62. Guess what? You were closed out of that position for the full loss without being able to manage it. Now, sure, you could look at Mobileye and say, okay, well, now let me go out to April, or probably more likely June, and sell a 62.5 call and maybe buy a 65. But you're not going to get the credit to repair this. Okay, you're not going to get the 425 on that one spread to repair it, unless it's in the money, and you're probably just going to have to roll that one as well. Of course, Mobileye is a bad example, because now that the whole market knows what the stock's going to do, there's not really a lot of premium on anything above $62 per share. It's all zeros, okay? And I think there's just the 60 strike as well, okay? All right, so John, you've been patient, but with this discussion, I had a follow-up question come in from Paul, so I want to get to that. Paul says, want to ask about a possible way to protect bull puts in the event of a big drop. Does it work to place a pending order with the broker to buy a put at your short strike price if the market goes down that far? Most of the time I am watching, so I won't let the market get that far. Okay, so what Paul is asking, now that, and if anyone has any question about the money we showed here about how you have to be right, you know, more than 80% of the time, if you've got an 80% probability on a spread portfolio, you know, please feel free to send those in as well. But what Paul is asking is that, let's say this is my position for NTES. We entered this bull put that we're talking about. And right now we're going to leave it as a bull put. But he wants to know, is there a way to protect the bull put? So now the stock starts to fall in price and it's getting near our short put strike price. He says he wouldn't let it go in the money. I try not to either. We know the unexpected can happen in the pre or aftermarket hours. We're talking on a regular basis. And he wants to know, does it make sense now to buy a put if the stock falls to the put strike price? Well, if it continues down, you could hedge it, but you could protect it, but is that going to help you? Let's say, for example, am I on a weekly spread here? I think I am. Yeah, 24th of March. So let's say on Monday, let's see, let's go, I'm sorry, let me go to March 24th. My apologies. Perfect. Okay, so there's a break in the middle. I'm just going to add it in there, but not as anything yet. So let's say, I'll go ahead and add that in. Let's say that the stock falls to our short put strike price of 285 on Monday. Okay. Let's see, and that would be 320. Okay, so we know the loss is here. What I'm looking at is this 282.50 put would maybe cost me 107 based on the Black-Scholes pricing model. Okay, so I could buy this put at 107 in between the two strikes. Okay, but that's going to give me this profit and loss chart. Now again, what are we talking about? We're talking about if the stock's actually here, not where it is today. So on Monday the stock drops to this point. You add a 282.5 put here to protect it. Well, of course, this one isn't really working because you've negated the entire net credit. You still have a loss here, the maximum loss of 282. Now, that's less than the 425 we were looking at. Okay, that is less than that. So now what happens is the stock continues to fall. You're in a ratio kind of put spread, and so you could make more money. All right, but let's talk about this for a minute. If it falls against you and you've got 3 days left, you're really expecting it to drop down to then 275, 270, 260, 255 to where this would start to take off and you'd realize a profit because you've got two puts sold against one. You're in a ratio spread that can profit to the downside. That's a lot to expect maybe in a 3-day time period. This might just be a 1 or 2 day hiccup in the market and the stock was brought down by it. And so that's why we talk about in some of our, this is an idea, but you'd probably want to go cheaper, right? We'd want to go further out of the money for that same expiration. And maybe we want to go to the 272, which is the stock fell, might be worth 40 or 50 cents. Okay, so we buy that cheap one. Okay, so originally we're still taking in a credit of 75 cents. We're paying 40 back for a far out of the money put that's cheap to help us hedge it. Will it? Yeah, and if the stock recovers, you might still realize a small profit of only 35 cents. But remember, the loss here is about the same, okay, because you didn't help the loss unless it really goes down. You see what I mean? The risk increased because you lowered the net credit. We took the net credit from 75 down to 35, and you still have the 5-point loss because your spread, your original spread of 285, 280 is in place, and you bought this as just an outside hedge if it continues to fall. But it needs to fall 270. Really, we probably need to be down about 255 on or around expiration. And maybe it's not that bad. Maybe it's not that low. Yeah, it's not, definitely not that low. My apologies. It's probably like 263, I think. Oh, okay. See, about 265, maybe 267 would be your break even to the downside. Oh, I'm sorry, 280, 284.65. No, I'm sorry, the downside's not showing. I'm right. It's about 270. Okay, sorry about that, folks. Now it's right between 270. You see where I'm going with this. So you need it to drop down below 270, 265 in order for that to take control. Okay, so what are some of the other things you can do? Well, in a lot of the webinars, in the repair webinar for bull put credit spreads, we talk about other adjustments to make. If the stock falls here and I think it's going to continue down in price, I may liquidate my bull put spread and convert it to a bear call spread, depending on the prices, or I may be able just to move this 280 put to a 290. Okay, so sell to close the long put, leave your short put there. So let's say the stock drops down to 284.70. Something comes out Monday, it drops down to 284.70, and I think it's going to drop further based on the news. We might use what we call the pendulum adjustment, where we take our long call at 280 in the bull put and swing it up to the 290. Okay, so we're going to change our bull put to a bear put debit spread. Now it is going to lower the maximum return on the position. It might not be 17%, it might only go to 9% if the stock stays below 285 now. Okay, and we only had to do one adjustment. We just had to do one roll on the position. We swung it out like a pendulum on a clock, on a metronome, going back and forth there. And that's a potential where you might be able to adjust it based on the price. Now what does that mean? It means the price of the roll, cost of the roll to the higher strike in the bull put. So cost of rolling the long option minus the credit received originally, minus the initial net credit, has to be less than the new difference in strike prices. Okay, so in this case, if I was now in the bear put debit, which I would have paid 285 to 290, the total cost of the roll minus the net credit would have to be less than 5 points for that to work. And again, it's not going to mean that I'm still going to make a profit of $75 or 17%. I'm probably going to cut this in half. But now, if my sentiment is changed and it stays down, I didn't have to close the whole bull put and then try to open a bear call to cover the loss. I just swung one option, converted a bullish trade into a bearish trade, and now we'll have a profit as long as the stock stays below 285. Of course, that can whipsaw against you in both directions. It can come back up after it drops, and now your bear put debit spread is losing. But that's another idea. Just keep in mind, why are you doing a bull put credit spread? You're doing it for the leveraged return, the net credit as well that you want to see, and because it's not giving you the profit and loss you want, but the risk reward profile you want with the probability. The minute, I do a lot with the radioactive trading techniques. I do a lot with the bulletproofing discussions using the married put and then making adjustments, and I always get questions, can I protect my bull put credit spread or my bull call debit spread in the same way? Well, you can, but now you're not trading a bull put credit spread anymore. You're trading a ratio put spread which has an entirely different risk reward ratio, which probably doesn't match your original sentiment for the stock itself. Okay, and can I protect a bear put debit spread, for example, by adding a call option to it? Again, yes, but it creates an entirely different position where you have 3 working legs. It's not acting as insurance. You're in an entirely new position. Speaking of positions and ratio spreads, our next question comes in from a different John. And John wants to know, have you found any option positions once established where you cannot lose any money? There is one that I know of. There are some that I trade in my personal account, but that's cheating because it's after making adjustments. All right, but once established, you cannot lose any money. Well, if I own stock that's up in price, I can add a put to it to lock in the gain. All right, so let's take my Ally position I was mentioning. So here's a position. If I had shares of Ally with a cost basis of $20 per share, and it's now up at $21.15, I could add a put option to create a married put where I'd have a guaranteed profit. So I have a 5.7% unrealized profit. I add a put to create a married put. I could lock in about half of that with some of these opportunities. So I could not lose any money and still have upside profit potential. But that is cheating, John, because I'm telling you after the fact. Already having the gain in the stock, or maybe having a gain in a long call and adding a put, or having a gain in a long put and adding a call, legging into it, you might be able to do what we call bulletproofing the position, where I have no risk to the downside and can still have further upside profit. Okay? Why was I trying to lead in after what we just talked about with the bull put credit spreads? A popular strategy that's advertised as broken wing butterflies and ratio call spreads. Okay, what's a ratio call spread? Ratio call spread, standard. I don't want to use eBay. Let me try MDLZ. It's a position I opened recently. I haven't looked at the options today. It does offer weeklies. I'm going to go 14 days out on Mondelez. There's one. Good job. Okay, so I don't like the strikes, but we'll use them. Oh, I could do that. I'm going to do the 44s and the 45s. And we've got a midpoint here of 16 cents. Okay, so we're going to say that we get 55 cents at midpoint for the 45 call. And for today's discussion, I'm going to cheat and say it's only going to cost me 105 to buy the 44 calls. Okay? All right. So we're going to buy, one of our March 44 calls for 105. It would be closer to 110, but I want to show the credit for this example. And we're going to sell 2 of the March 45 calls, and we're going to say we're going to get 55 cents at midpoint. Okay, let's do that. This is now a ratio call spread. Okay, now, is this a position that cannot lose any money? Absolutely not. Your risk is infinite to the upside. Why? Because you have 2 short calls on the position. One of them is essentially a naked call, which carries infinite risk, and the other is a bull call debit spread, buying the 44 and selling 145 and then just selling the naked 45 call. You get it at a credit, in this case at 5 cents. But you see here, what I'm looking at is if the stock falls, you're guaranteed that profit because all the calls would expire worthless. Your risk is only if the stock moves up. And you can do it reverse with the puts, and it shows the same graph. Now, the popularity for broken wing butterflies came out with, let's say we got better premiums. And I know I'm kind of cheating here, but let's say I got this at 60 cents and it only cost me $1 to buy the 44. So now we're getting a credit of about 20 cents. Now to protect the upside, I look further out, or same expiration even, but instead of going 1 strike apart, I go 2 to the 47 strike and I pay 10 cents for an extra outer wing. Now, this is not as good of a broken wing butterfly as I'd like, but in this case, of course, this is more of an iron butterfly with an extra long wing. But you see here now, we've kind of got this position that has less of a loss to the upside, but it's not quite what you're asking. Okay, I know that. I'm just going a roundabout kind of way. But the idea behind the broken wing butterflies is that you can enter a butterfly that doesn't have too close of an upper and lower break even. You can still take advantage of having a positive profit to the downside with only risking, 90 cents to the upside. But again, yeah, it offers a 57% return if and only if the stock's trading right at 45 14 days from now. Okay, common discussion. I say in a lot of webinars, I never trade short straddles, iron butterflies, all call butterflies, all put butterflies in my personal portfolio. Why? Because I can't do this. If you can pick consistently where a stock is going to be trading right at a strike price, and by consistently again, I mean close to 80% of the time, okay? But if you can do that consistently, pick exactly what strike a stock is going to be trading at in a 7 to 14 to 20 day time period. You don't need to be here on this webinar. I can give you no information because you're making millions and millions of dollars in the market. You can trade butterflies and short straddles and short strangles all day long and just make profits left and right. Probably closer to 80-85% of the time if you can do that. But I can't do that. I'm not going to say I can do that. That's why I don't trade these strategies, because it's really based on maximizing the return and getting as close to this position as possible. Now, is there an option position once established you cannot lose any money? Yes. There are things called conversions and reversals. They're forms of long and short collars. Okay, so in a standard long collar, I might buy shares of stock, sell a call against it that's at the money or maybe 1 strike above, and buy an out of the money put. So I get a risk-reward profile that looks like a bull put credit spread. I might be looking to make 2% to the upside while only risking 4% to the downside. Okay, that's a standard collar. Now the short collar is the reverse. I short stock, buy an out-of-the-money call, and sell an at or out-of-the-money put, and it gives me the reverse position. The short collar is, of course, this, but I'm short stock, and it mimics a bear call credit spread portfolio. Let's take a look real quick. I know everyone knows pretty much what probably a collar is, but let's take a look here. I'll use, this probably won't give us what we want, but I'm going to use Delta Airlines as an example. Oh, no, it does give us what I want, but that's not the search I want. Let's look for a standard collar out to April. Perfect, there's Delta. Okay, so let's go to the profit and loss chart. For this collar, I could buy 100 shares of Delta at $46.51. We could sell the out-of-the-money 47.5 call for $1.30 and buy the 44.5 put for 74 cents. So I'm still taking in a positive premium of 63 cents, which lowers my total cost into the position down to $4,594. If the stock moves above 47.5, I'm going to make 3.4% at assignment. And if it falls unexpectedly, the most I can lose is 3.1. So we're at a close to a 1-to-1 risk-reward ratio, and we had to put up $4,500 to get in this position. Now, another form of collar that can be used is with the stock at $46.51. What happens if we go out to April? Not April. Let's go to March 31st. If I sell the $46.50 call and buy the $46.50 put, and we're going to get about $1. Yeah, let's call it $1 for the $46.50 call and 55 cents for the $46.50 put. All right, so we're going to sell this for $1. And my bid ask, I'm sorry, again on the put is 49 to 59, so let's call it 55 cents to buy the put. Okay, now I get a 45-cent net premium, which lowers my cost basis down to 46.06. But remember, I sold the 46.50 call. So if the stock's above that, I get 46.50 back, and I make a profit of 44 cents. And if the stock falls in the next 14 days below 46.50, I exercise my put, get 46.50 back, but I only paid 46.06. So this looks a little strange, but let me clear it up for you by going to expiration. The conversion, same strike collar, can guarantee a profit no matter what the stock does. This is exaggerated a little bit, and I'm not sure why. I mean, it looks like a little high here for the premiums. I don't know if we'd be able to get that come Monday morning. But in this case, yeah, so we get 7 cents up to $1. I mean, $1 midpoint would be reasonable here. 55 cents would be reasonable here. And the stock's at 46.51. This is much higher than I expect to see. Okay? There are conversions available. Let's think about this for a minute. How much money can you put into the position? You are still buying stock, and you're selling a call and buying a put here. So in doing that combination, if you're going to put $10,000 into it, you could do 200 shares and 2 calls and 2 puts, and you'd guarantee an $88 profit, okay, in 14 days, a 1% yield for 14 days, guaranteed no matter what the stock does. Can't make more than that, can't make less than that. Okay, but you would take in the potential profit of $88. What are your commissions for doing a collar? It might be $15 or $20. Let's take 15. Oh, let's take 15 off, so that lowers us down to 63 at the onset. And then one way or the other, you're going to get assigned. So if you pay another $7 there, now you're down to $56. Okay, total profit. Now that's for 200 shares. Right, we start off with a potential 88. We lowered it down to 56 after commissions, perhaps, depending on your commission schedule. So here's what I'm getting at. Conversions and reversals, the short collar guaranteed profit, straight line profit and loss chart, when doing it by buying stock in a long collar format, it's called a conversion. Doing it with a short collar format of shorting the stock, shorting the put, and buying the call is called a reversal. Main thing you have to watch out for a reversal is you don't want to do it on stocks that pay a dividend, because if you cross the ex-dividend date, you have to pay the dividend. That might wipe out the profit. But let's go back to the long collar search. We have a default search that's set up there for you called conversions. Sometimes you can go further out in time. But in general, you're talking about a 0.3 or 0.2% guaranteed return for maybe a 35, 20 to 14-day trade. Ask yourself, is that worth it? They sometimes do exist. You've got to fight for the midpoint in order to get filled to make sure you get that guaranteed return. But the profit here, look what we're talking about, 4 cents on a 1581 stock, 5 cents on a $16 ETF, 33 cents on a $46 stock, which isn't bad. It's a guaranteed profit of 0.7% or so. There just seems something weird to me about that right now. I don't know why. Here's Walmart. Here's a potential in Walmart. A guaranteed 12-cent profit for a 35-day trade, which is 0.2%. Does that match your trading goals? Yeah, it's a guaranteed profit, but how ahead are you getting, depending on how much money can you put in the position? Okay. Arbitrage trades, conversions, reversals. As someone mentioned, of course, the positions I trade on a general basis are the married puts, which start off with a low risk on the position, but as I make adjustments and roll the position up or down, there's T-Mobile, up another $1. I was going to enter that position a week ago, but I didn't. I traded something else yesterday. That's okay. So the married put, I'm going far out in time, in this case out to August, which is a good 5-6 months away. I do have a risk of 6.7% in the worst case scenario to start with. Looks a lot like a long call. But as the stock moves up or stagnates or moves down, I'm going to use 12 different adjustments we talk about in the product called the blueprint to pay off the 470 at risk. Okay, so once I lower my cost basis, let's say down by selling calls, doing spreads against the position, which won't increase the risk, but let's say I knock my cost basis down to not $29.40, generate $3 or $4 over the next 2 to 3 months, knock my cost basis down to $59.40. Well, now I'm at a position where I'm almost bulletproof on the position where I have no risk to the downside and could still realize further upside profit. Okay, so those are kind of the ideas as far as, is there any option strategy which takes on no risk? Other than legging in, the only thing that you can do is one of the conversions or reversals, and it probably won't match your trading goals. Okay, even for a 30, 40, 50-day trade, you're talking about a guaranteed return, but probably only about 0.2, 0.3, 0.4, maybe 0.5%, maybe 0.8% at most. And that's for being 30 days out. Does that match your trading goals month by month? You're not losing any money. You will give some up to commissions. So even those ones we saw that were a 1% return, you're really probably talking about 0.7% or 0.6% after factoring in the commissions to get into the position and then taking assignment on one of the legs or the other. If you have a stock that's moved up in price, can you create a credit spread with no risk? Yes, by legging into the position. Okay, let's say I bought a put and the stock moved up in price. Well, I could sell a put, or I could roll the put up in price and then sell a put, and I'd have a no-risk bull put credit spread. But it has to be legged in. You can't do it from the onset. Okay, there's no position I know of other than the conversions and reversals. Long way to answer your question, John, that can do that. The other strategies don't really take care of that for you. And it's a hedge game. Sam's online today. He was online. I don't know if he still is. He said hi earlier, and I'm sorry, Sam, I didn't get a chance. Yeah, Sam's still here. Sam and I have talked in the past during these webinars. He will tend to maybe leg in and leg out, have a naked put, convert it to a short strangle by adding a short call, and then maybe add a long option to protect which direction he thinks it is. So he's sort of legging in and out from time to time on different positions. Some of them may end up with a no risk, but he has to work at it. It's not done from the onset. Or he has a gain in a stock or a gain in a long call that Sam might adjust and add a credit spread to, or something where the credit spread might not have no risk on it, but the combination of the three might, but he's planning on rolling and adjusting. Okay, there's no free ride. I was talking to a gentleman earlier today, one of our PowerOptions customers. I'm sorry, it was actually about the conversions. The same gentleman I was talking about the conversions. He does conversions only. And he has his own proper setup and search that he uses for the same strike collars that he trades. Of course, he reminded me today that he used to do the reversals in the short collars, but he can't anymore because of the new charges that they came out with for the shorting the stock, the reversals, and those kind of things. What is it called? I can't remember the name of what it is that the banks are calling it, with shorting certain shares of stock and then trading options against them. but it's no longer worth his while to do those trades at the 0.7, 0.8, 0.6% clip because of the fees they charge with the short side of the trade. Even if it's done in a collar, it's not a short stock, but even done in the collar, it's no longer profitable for him to do that, so he only focuses on conversions right now, the form of the long collar, by buying the stock, selling the call, and buying the put at the same strike, looking for a credit to have a guaranteed return. But does this match your trading goal? Oh, I'm sorry, it just says Jay. I don't know if it's a John or another Jim. It's a different question that came in. It says, well, couldn't you get a higher return on these conversions if you went further out in time? Well, yeah, I might see a guaranteed profit of 1, 1.5, maybe even 2% going out to the January 2018 or 2019 series. Not really, though, but ask yourself this question. Let's say we go out to January 2018. Okay, here are some that are at 1% for 300 days. Again, guaranteed profit, potentially at a 1% guaranteed profit on Twitter, on Facebook is a conversion here with the 135 strikes, but now we have to ask ourselves, is it worth it? Does this match our trading plan at 1% for essentially a year? Okay, 10 months. Is that your goal, to make 1% in 10 months? Okay, so that's what it comes down to. Are they available? Yes. Do they match your trading plan? Probably not. Paul says, with regard to conversions and reversals, do you reach an acceptable return if you purchase the stock on leverage? I'm going to say no, because if you trade the stock on leverage, your broker is going to charge you a borrowing fee. How much is that borrowing fee, and how much is it going to negate the profit? Remember, we were talking about guaranteed profits of 0.2, 0.3, 0.4% after the commissions. Then you pay a margin fee for borrowing the shares of stock on top of that. Where's your profit now? Okay, so I'm going to say it could be done. I don't think it's going to increase the return dramatically because we're talking about very small amounts of money with the conversions and the reversals. Okay, check into it. Look into your broker and what they would charge. Okay. Okay, and Paul says in Europe we can secure a stock position using a 10% using spread betting. Okay, yeah. Look at what your broker would charge for that and what their commissions fee would be there, and then we'll see what we can do, okay? All right, perfect question, Jim. I love it. And this relates to me and, of course, relates to you as well. All these have been really good questions. Don't get me wrong. Jim says, now, with all of this going on, we're talking about bull puts and ratio call spreads and yada, yada, yada. He says, basic question, how many of these option strategies are available to a normal IRA investment account? Great question, Jim. I myself, most of my funds are actually in a restricted account at Fidelity, an IRA account now at Fidelity, and I am qualified at this moment to do, I'm sorry, I was looking for my custom spread. There we go. Okay. So let's clear this out. I am qualified in that account essentially at level 2 trading with a kick. Okay, it's not level 3, but it's level 2 with a kick. So originally, I was able to buy stock, sell covered calls, buy calls, and buy puts. Okay, so what does that allow me to do? Oh, let's go to a different view here. Let's go to the other strategies tab. With just that level of trading, okay, so the level-ish 1, level 2 here in my IRA, the level 2 in my IRA is buy stock only. I'll just put plus stock. Covered call. Of course, if I own the stock, I can sell the call against it. Buy calls, which may not be allowed at level 1 in some IRAs, and most IRAs, buying a call and the covered calls are allowed, and then buy a put option. Okay? All right, so what does that allow me to do of this list? Well, naturally, I can do a covered call position. I can do a long straddle and a long strangle, buying a call, buying a put, speculating on a market movement one direction or the other. I can do married puts, buying the stock and buying the put against it. I can do the long collar or the standard collar, which of course would be the covered call with an extra put. Okay? And of course, in my account, I'm actually able to do the I'm sorry, I'm actually able to a cash secured, let me take that out, cash secured naked put, CSNP, the cash secured naked put. Okay, so I can do naked puts as well. In a sense, this also allows me to do something where I'd buy stock and do a bull put credit spread. Okay, so I can buy stock and then I could sell the naked put and buy a put. It doesn't make sense for me to do that though, because what I'm doing in my brokers, I am trading a bull put against a long stock position. Okay, a bull put credit spread where I sell a put and buy a put because I'm doing a cash secured naked put and then buying a put. But because my broker doesn't allow me to do spreads, what this means is I had to put the money to buy the stock, and of course I had to do the money to short the naked put position. Okay, so I could just do the cash secured naked put and then buy the put option, but I don't get that spread benefit of only putting up the 5 points on the spread. I have to have the whole cash on hand. Even though this is a put that's covering that, the brokerage doesn't allow me spreads in that IRA, so I'd still have to put up, let's say, the $4,000, $5,000 that I would need to buy the stock at this price, and I can still buy the put. But I've got the limited risk of a bull put credit spread, but this is really more, you know, two different positions. I had to put the full monetary amount on hold in my account. Okay, so that's what you can do there. Larry says, can you do a ratio spread if you own the stock? Talking about the IRA. No, I can't. In this account. The accounts that I do income method number 5 as part of the radioactive trades when I'm in a married put are not done in this Fidelity account. They're done in my Options Express account. And the reason why is because, now there's a trick to this, Larry. Let's go to a married put. Let's go to the married put I just opened the other day. Okay. And it was on Mondelez. This is for our Fusion subscribers. I opened a position on Mondelez. Let's see, add stock in and then buy a January 47 strike put. Okay, oh, I got to put in the numbers here, folks. There we go. All right, so this is close to what I have at this time. Now, Larry, with the married put position and the 12 income methods available, even in the restricted Fidelity account, I can do income method number 1, of course, number 2, number 3, number 4, number 6, 7 in my Fidelity account. Can't do 8. I can do 9, 10. I can. I'm sorry. I can't do 8. Can do 9. I can do 11, and I, of course, can do 12. So I can do all of them except for 5, which is the ratio call spread for the income methods, and 8, which is doing a form of the condor. Okay. Now, with 100 shares and 1 put, Larry, I still, in that restricted Fidelity account in the IRA, I cannot do that ratio spread. Why? Because they would still look at it. Yes, the first call I'm selling is a covered call, but the other combinations would be a bull call debit spread. Okay, so they can't allow that. Now, if you own the stock and you sell 2 calls and buy 1, you're still doing 1 spread. Okay, you're still doing a bull call spread. You have 1 extra short call that has to be covered by the call, and they count that as a spread, Larry, so that can't be done. Okay, but if I owned 200 shares of just stock or 200 and 200 in the married put, I could do the ratio call spread now on Mondelez by selling 2 and buying 1. Okay, so I could still do the ratio spread, but I couldn't do a 4-to-2 spread. But if I did 2-to-1, the ratio call spread against the stock and the married put combination, which this one's a bad one, but yeah, I could do that. Because now all my broker sees is I have 2 short calls, which are covered by my 200 shares of stock. So that can be done, and then buy the extra call. But if I tried to do 4 calls and 2 puts, that wouldn't work, because these 2 extra calls can only be covered by these calls here, and my broker would see that as a spread in my IRA and not allow it. That being said, some IRAs are very easy to get. Larry, you just followed up like that. Is TOS like that? I don't think so. To tell you the truth, because their bread and butter is options trading, and they might, they're focused on options investors, so places like Thinkorswim, Interactive Brokers, Options Express, Trade King, Options House. When you apply to trade options in an IRA, they might get you to that level 3 where you can do spreads. Maybe. I would ask them. But Options Express, I know when I first opened my account there, they already put me at level 2. This was years ago, 10, 12, 14 years ago. They set me at level 2, which allowed me to do spread trades in the portfolio with a certain limitation, meaning I couldn't, I can't remember what it was. I couldn't do spreads that were more than $7,500 at risk if you had an account greater than $10,000. So some number I can't remember now. But for Fidelity, I don't even think I can apply to do spreads in the IRA. I can do 95% of the spreads that we do inside the radioactive trade because I own the stock. Okay, so I can do the broken wing butterfly income method number 11 against the stock because I own it. I can do income method number 5 done in a different way, as we just talked about, even though I can't trade a spread in that IRA. I can do 6, which is the bear call credit spread, because my broker doesn't see it as a bear call credit spread. And essentially I could do a bull call debit spread if I own the stock, because my broker wouldn't see it as a bull call debit spread if I own the stock. They'd see it as a covered call with an extra long call purchased. Okay. So check with Thinkorswim, Larry, and see what they say to you. But in general, you probably get a little bit more leeway on using spreads in your IRAs. I say that and now I have to retract it. I don't know for sure. Thinkorswim and Interactive Brokers had that option. I know that for a fact. And so did Options Express. Now that Schwab bought Options Express and TD Ameritrade bought Thinkorswim, I can't promise you that there still is lenience, because the older guards, TD Ameritrade and Schwab, probably still cover their bases a little bit more and related to options trading in an IRA account. You check with them. Let me know what you find out too. I'm very interested to know. But you check with them and you let me know, and they'll give you the best answer. Okay. So Jim, I hope that answered your question. Once again, let's go back to where we were here, if I can find it. I'm in the wrong place again. Okay, sorry about that. But let's just go here to other strategies. So in a standard IRA, if you have level 1 trading, or sometimes it's called level 2, you have covered call, the long straddle and long strangle, because you can buy a call and buy a put. I'm sorry. Yeah, you can just buy a call and buy a put. That's the same thing. You can do a long call, long put, long straddle, long strangle. You'd be able to do the long collar position. You can do a married put. And that would be about the basics to start off. I forgot long call and long put to begin with. I just, say buy call, buy put, so it was already there. So long calls, long puts, collars, long straddle, long strangle, married put, covered call. And if you can get applied to do naked puts, cash secured, you could do the covered combinations, but it would cost you twice as much money, because you do the covered call and then you add the naked put, and there you go. And then you'd be able to do naked puts as well. Okay. All right. So that's what you'd be able to do in the IRA in those positions. Okay. Ladies and gentlemen, it is 5:45 p.m. Eastern Time. I don't see any other questions coming through, but if I did miss a question, please, of course, just let me know. And if you have any last-minute questions, go ahead and send those in. I'll be more than happy to handle them. But as I mentioned, of course, we are at 5:45-ish p.m. Eastern Time as well. So with that being said, if you have any last-minute questions, show them in. I just want to remind everyone, if you haven't done so yet, if you're just joining us maybe this is the first time joining us, remember you can take a 14-day free test drive of Power Options. Just go to powerop.com and you can put in your first name, last name, and email address, and you'll get 14 days free access to the site, the 20-minute delayed site with all the tools and the portfolio tools and more. And of course, then following the 14-day free trial, we do offer different services. We have an end-of-day service, which is $40 per month. Okay. We do have the delayed service, which is $60 per month. So you get access to all the tools with 20-minute delayed quotes. At the end of the day, you only get one update per day. Do you have the 20-minute delay at $60? We do offer back testing that works similar to our search. You can upgrade from the 20-minute delayed to the historical. So the full 20-minute delayed and historical is only $100 per month. And we do offer a real-time at $120 per month as well. And of course, the premium service, which includes everything. You want to see other information, remember you can check us out on the blog at any time, blog.poweropt.com. We did record today's presentation. We will post it in the webinar archive this weekend or first thing Monday. Remember, you can check out our archived webinars at any time, powerop.com/webinars.asp, or you can do it on our YouTube channel as well. You can just go to youtube.com, look for Power Options, or youtube.com/user/PowerOptions to see the public videos we've posted there on YouTube, and in addition to what's available in the webinar archive on Power Options as well. All right, well, if you think of any questions later on, I didn't see any new questions come in. Jim says, thank you. I just have to learn all these strategies. Yeah, and you might want to start off with taking a look at some of the radioactive techniques with the limited risk play in place first, Jim, and then from there, still doing the other trades off of it, knowing that as you're trading, you can't lose more than that 3 or 4%, similar to standard collar positions. Rather than maybe taking the chance on covered calls, which still leave the downside open, or even out-of-the-money cash-secured naked puts, which can move against you, starting off with the limited risk trades with the married puts or the collars might be a better approach to start off with than sort of the risky covered calls, depending on the market situation as well, with what you're allowed to trade right now. But again, if you think of any questions later on, remember, send me an email at any time to support@powerop.com. And if you have questions about the radioactive trading techniques, the limited risk techniques, you send us an email to support@radioactivetrading.com. Also, of course, at any time, remember, you can call us during market hours at 302-992-7971. Or, of course, we have a toll-free number there if you live inside the U.S. at 877-992-7971 as well. Ladies and gentlemen, have a fantastic weekend. I hope you all enjoy your St. Patrick's Day if you're going out tonight, or even if you're just staying in with your family. I look forward to seeing you next week as we talk more about investing and we see what the market has planned for us and how we can plan to better our positions based on what the market does. So take care, everyone. Have a great weekend. We'll see you soon. Good night.